So let's move on to the third reading, the governance of risk management. Now, corporate governance has become very important recently, as you all know, that even the corporates need to be governed now by a framework because there have been cases of frauds, etc., and investors have lost their money. So it is very important to establish a framework. The government needs to make rules, etc. But we obviously know that the government is not completely inefficient. They only take action after a crisis strikes. So just like the League of Nations was formed after 1920, in 1920 or so, when the First World War ended, but it failed to prevent the Second World War. So the United Nations was formed. Similarly, in business and finance, so to say, different regulations were made after a small crisis happened. But then even larger crises happened. So those regulations were updated and made more stringent. And even now, crises happen. Like in March 2021, Archegos Capital caused losses worth 20 billion to different investment banks. And if that effect had not been monitored and controlled, it might have spilled over into a lot of economies as well, and might have taken a bad shape like 2007-9 did. So let's see, it's a theoretical reading. You will need to read through most of it. There is nothing much for me to explain. Whatever it is, I will explain. In a very broad sense, corporate governance is the series of processes established to operate a business. Okay, it involves shareholders management and timely, ultimately the board of directors. So there have been corporate governance failures in Enron, WorldCom, Global Crossing, and Paramalat. I would recommend you to read all of them. They're very interesting. Just go to Wikipedia and read. It'll give you a brief overview of whatever happened and why it happened and how it could have been prevented. So the US federal regulation developed as a result of systemic failure, like I told you. So the Sarbanes-Oxley Act, SOX, was one such effort. It imposes strict financial reporting and auditing parameters on public companies. Okay, so these are the practical implications of SOX. Let's say the CFO and CEO must personally verify the accuracy of financial filing. They must attest all disclosures. There must be internal controls. The reporting procedures must be audited. And the basic things is you just need to read it and keep them in mind. There might be one question from here and there. So the next is governance after the financial crisis. Again, like I said, the failures flowed from declines in underwriting standards, a general breakdown in oversight, with management being more concerned with short-term profits than long-term decision-making and overuse of complicated structured products. So, like I told you, the management kept taking those one-day loans and investing in 30-year products, which caused a huge mismatch, and it ultimately led to the demise of the banks. And these assets also were not as good as the banks imagined. They were, as you would call it, so full of shit because they were subprime. You should see this movie called, what was that? I can't recall the name right now, wherein they talk about these different financial products and everything, and people come up like Richard Thaler came, Margaret Robbie came, and she was talking. I can't recall the name. Why isn't it coming to my mind? It's such a famous movie, The Big Short. Sorry, yeah, The Big Short. It's really interesting. You should read it when we're doing the chapter on structured products, and it'll be very clear once you've seen that. It's a very interesting movie on the 2007-9 crisis. So the key lessons learned from risk management failures were that you need to consider a stakeholder priority. You just need nowadays there is not only just the shareholder priority, that is profit is not your only motive. You need to consider the well-being of all the parties involved, your investors, uh, debt holders, shareholders, customers, employees, management, everyone. Next, board composition. Board composition must be independent and engaged in supervision and collection of professionals who hold a level of industry expertise. Obviously, there needs to be proactive oversight. There must be an established risk appetite framework, and compensation structures must not be based on profits. For example, usually you will get a higher bonus if you earn more profits. That should not usually be the case because then you will take more risk in the benefit in the hopes of earning more benefits or more returns. And what they've said is that you can use deferred bonus payments. For example, your bonus will be sent to an account and you will get the sum total of that account 5 years later. So at least for 5 years, you know that the employee will not do something bad, that will lead to the demise of the organization. Then the Basel Committee on Banking Supervision, which is the elite risk management, usually the operational risk management framework that was built. The Basel I Accord of 1988 created a uniform approach for banking capital adequacy standards, and the accord focused on managing credit risk by recommending minimum 8% of a bank's risk-weighted assets. So the economic capital must be at least 8%, and then above that, you take uh, as much as possible. The Basel II replaced the Basel I and included both trading and lending activities in capital adequacy standard. So what happened is that they only talked about the lending aspects of the bank, but banks also have a trading division, which is more risky usually than the trading division. So this trading was also brought in the purview of the Basel regulation. Third one, Basel III is in a direct response to the 2007-9 crisis, and it considers both company specific factors and market level, the unsystematic and systematic factors. And you need to remember these two terms, which are liquidity coverage ratio and net stable funding ratio. So, under the current regime, Basel III limits Tier 1 capital to include common equity and retained earnings. It also imposes a liquidity coverage ratio wherein banks must hold enough equity to must hold enough highly liquid assets to fund 30 days worth of cash needs. And also, this is so the liquidity coverage ratio talks about short term. You can write short term on the side, and the net stable funding ratio talks about the long term. It was to encourage banks to have at least 1 year's worth of stable cash flow to fund their operations. The last step was to add a macro prudential overlay, big word, don't need to worry, to lessen systematic risk and pro cyclicality, which means you must take not more than you must have at least 3% capital to your assets, which is your leverage ratio. The second one is that counter cyclical capital buffers. So you need to maintain buffer capital, obviously, and especially in times of crisis you need to maintain higher capital. But what happens is that in times of crisis usually your capital goes down, and you would want to even reduce that buffer capital so that you can use the amount to earn more returns. But you should not do that. You should keep a buffer capital during crises. All globally systemically important banks have minimum total loss absorbing capital standard. So all important banks need to have a loss absorbing standard. They cannot just fail. This will lead to the demise of the portfolios and assets of hundreds of millions of people. Now Basel III is encouraging people to clear trade centrally, which means that you and I don't trade directly, we trade through the exchange, so that all of the trades are under the purview of or under the control of an oversight body. And the last one is the risk modeling and stress testing are being modified to better capture tail risk. Like I said, the 26.69% in the VR that was visible, you need to capture that entire last 50 days of data very accurately, and you need to understand the probability of each event happening as well. Then there were revised guidelines. Just read through it. There's not much to explain over here, these 12 guidelines, but you need to know them. It's important to know at least what they mean, and there might be a question or two for the from in the exam from this reading. So in 2016, Basel III was expanded to include the fundamental review of the trading book. Like I said earlier, the trading book was not included; only the loan book was included. So now even the trading book was included under the framework, and banks needed to consider that as well. So while this happened in Basel 2 and 3, let's talk about the history of that. So previously, banks operated under the Glass-Steagall Act, wherein banks could not trade under that same firm. They have to establish a separate entity. Under that, they will trade. After 1999, the Graham-Leach-Bliley Act was passed, wherein they will trade in a holding company. That is, they will have a holding company under the bank directly, in which they can execute trades. And after the 2010, There was the Dodd-Frank Act, which is very important. We'll see these are the seven provisions of the same, which we'll have to read about. So it strengthened the Fed, and oversight was given over all the GSIB, globally systemically important banks with assets greater than 50 billion, ending the too big to fail. So there was a notion of too big to fail, but Lehman Brothers did fail. It was too big and it did fail. So there was a liquidation authority and a bankruptcy proceedings court built for that. And the third one is that there was a resolution plan. So SIFI is also again a term, systemically important financial institutions. SIFIs will submit a living will. So what is a living will? You submit a will that in case your firm goes into bankruptcy, this is the process of liquidation. Simple. The fourth is a derivatives market. Transparency was encouraged in the derivatives market by centrally clearing trades and educating people about the risk prevalent in the leveraged products. The fifth one is the Walker rule, which is important. That's why I've highlighted it. It prohibited banks from engaging in proprietary trading. Banks were not allowed to trade with their own money because if there was an uncertain scenario, let's say a systematic failure in some aspect, the banks would not only lose their trading money, but losses would also increase in their loan book, and it might cause concerns about the viability of the bank. Next one is consumer protection. So, the consumer-based financial products such as options and futures were regulated even better, and people were again educated about the risks inherent in those products. The last one was stress testing. So banks needed to do a top-down stress test of you stress each variable to the extreme and see how it impacts your organization. So governance versus risk management best practices. Here we see what is the difference between corporate governance and risk management. What are the best practices? So required for the board of directors, what it says is that the board of directors should comprise of majority of independent members who have a basic knowledge of the firm's business and who have been given supplemental training. This is under corporate governance. Then the second one is multiple stakeholders. There's a conflict of interest. Obviously, like I said, debt holders versus stakeholders. We've done this earlier. The third is a principal agent conflict. So this is agency risk. Again, this is one of the most important risks prevalent in many organizations. What happened is that managers usually take short-term risks so that they can get higher bonuses. And stock-based compensations and incentives are given to the managers so that the long-term viability of the firm is considered by these managers as well. Because if they become a part of the organization's uh, shareholders, they will think of a long-term. They will think from a long-term aspect of holding the shares for long term, and they will lay more focus on the long term viability of the organization, so to say. And also clawback provision, wherein if you want, let's say you earn a 10% bonus this year, because you earn 10% of, let's say, 10 million, you earn 1 million bonus this year, but next year you lose 50 million for the bank. So your 1 million will be taken away, obviously. That you can't keep that, enjoy that 1 million. Next year you won't get any bonus. So it says that the CEO and chairman role should be segregated. Why it says that the board should consider the introduction of CRO. It helps in dividing the all the steps of the organization. That's as simple as that. Because the CEO might want to take some risks since he is in the management, but the chairman and the board of directors might not want to take that risk, so they can stop him, or other way around. So now we move on to see how all of these things are different in risk management. Each successive macro level crisis reinforces the need for board of directors to play a central role, and it is the board's responsibility to ensure that the firm's risk appetite is adequately communicated. The board should encourage the firm to strive for economic performance, not accounting performance, which means long term, not short term usually. The board and sound risk management mindset should influence strategic planning. You need to plan strategically for the long term. Again, everything talks about long term, long term, long term, because you can earn profits in the short term, but you usually firms fail in the long term, who go to manipulating their profits in the short term. From a practical perspective, the board should take the following steps in executing their risk management duties. Clearly articulate the risk appetite, which risks have to be retained, avoided, mitigated, transferred. The CRO role should be established. The next one is there should be a risk committee. Like there are different committees. There is an audit committee, there's a management committee, there should be a risk committee as well. And we need to consider risk adjusted returns of managers. One manager might be taking very high risk and earning, let's say, 10% return, and a manager might be taking very low risk but earning 8% return. So I think the second manager is better. Maintain an independent audit committee to monitor relevant actions. So if audit is in the hands of one person, he might be manipulated, but usually if it's an entire committee, there is low probability of all of them getting manipulated. So the next part talks about the implementation of the risk governance. The first one is to establish a risk advisory board with a risk advisory director who is an independent director who intimately understands the risk factors of a given industry and can advise the board on specialized risk exposures. He should attend risk committee and audit committee meetings to provide industry specific guidelines. Just read through it, nothing to explain. He just tells them these are the best practices, you need to follow the rules like a class monitor. So next is the risk management committee. So there is a risk management committee with the CRO heading it, and they are responsible for setting the risk appetite, monitoring the risk, maintaining contact with internal, external auditors to ensure compliance. Nothing for me to explain. So just read through it. Compensation committee, like I discussed, there should be stock-based compensation rather than bonus. There should be clawback provisions. There should be deferred bonuses. Then there is the risk appetite versus business strategy. So the first is set risk appetite as per goals and tolerance. So I want to earn very high return. So my risk appetite should be set accordingly. I want to earn nominal return. So my risk appetite should be set accordingly. That's it. That's what this first point is. The second one is the role of board of directors and CRO. So the supervision hierarchy needs to be understood and is important in the pursuit of linking risk tolerance to business strategy. The board sets the risk appetite through the risk committee, which is a subset of the board. The CRO is responsible for the day-to-day supervision. It just talks about the role of the board and CRO and how they are responsible for setting the risk appetite and business strategy. Third one is the risk return trade-off. Like I said, if I want to earn a higher return, my risk appetite should be high. If I want to earn nominal return, my risk appetite can be low. Repetitive. Fourth one is design risk limits. You design risk limits for each uh, division or each manager or each industry, whatever, that you can't take more than this much of this type of risk. It's simple. And there might be a breach of this risk, but you cannot completely stop that. The manager might explain to the CRO or the his immediate supervisor that how taking this risk would benefit the firm and how this risk might not impact the firm in the short term. So there might be exceptions as well. The last one, I think, is the role of the compensation committee. Again, you make employees work for the long term, not for short term profits. That's the crux of this. Eliminate bonus guarantees, use deferred payment features, clawback provisions, limit percentages, establish disclosure requirements. There should be independence of the compensation committee. That's all in this learning outcome. So the next is the interdependence of functional units. So there are different units: the board, the senior management, the business unit, the finance aspect, and the risk management. So everyone needs to be independent. Everyone needs to be working independently because let's say what happened in Barings Bank, Nick Leeson, was that he was the trader and he was also his own supervisor. So in that case, he was making rogue trades. He was trading using the client's money, and there was no one to supervise him because he was the supervisor of that desk, so to say, of that region. So, which is why he could enter the trade, false trades, and manipulate the books of accounts. And when the crisis was exposed, I think the bank lost over 1 billion at that very long ago, which was a huge amount at that time. So it says that the risk committee, the board of directors make the risk appetite, the risk committee approves it and manages and monitors it, whereas the ma- actual frontline managers, they implement this risk management process in their daily activities. So there are many examples of independence among functional units. Senior management sets the risk appetite, designs the policy, evaluates performance. The business units, they take the approved policy and implement it with exceptions, like I said before. Then the finance operations functions physically execute the risk management and transfer transactions, for example, if there is an insurance to be taken, etc. And they also analyze current market trends, risk management tools, etc. And the risk management function, led by the CRO, monitors this risk limit and controls the risk management process. So we move on to the last part, which is the audit committee. I think you should read it. There's nothing to explain. They basically, the audit committee needs to be independent. They need to do good. They need to not commit fraud. They need to not furnish the books of accounts incorrectly, and they should be monitored, obviously. And they need to sit with the risk committee together. That's all. You just read through it. There's nothing much for me to explain. That was this reading. Very easy.